Good evening, everybody. My name is Martin Stanley, and I'm here at Rowley Turton, introducing you to the latest of our series of webinars on topics which we hope will be of interest or even importance to our clients and perhaps people who would like to become clients. This evening's topic centres around private medical insurance, and we're doing things a little bit differently this evening in that we've got a couple of guest speakers. First up will be our very own Scott Gallagher, who's going to be talking to you about private medical insurance, a few case studies of how it's important and how it can be used, and also something you might not have thought of before, which is how private medical insurance can factor into your inheritance tax planning. After that, we're pleased to have Sam Townsend from IHCS, a specialist medical insurer, who is going to tell you some ins and outs of medical insurance, and he will be the guy to speak to if you actually want to take action on your medical insurance. He's the expert which we turn to at Rowley Turton. After that, we're going to hear from Rebecca Gotch from our sister company, Rowley's Accountants, and she's going to talk about some aspects that will be of interest to you if you're looking at medical insurance from a business point of view, because there's some changes in the offering to do with how medical insurance is treated with payroll and as a benefit for employees. So before I hand you over with Scott, a little bit of housekeeping first. Your cameras and microphones will be muted, so don't worry about that. Also, there's a Q&A, question and answer facility, probably at the bottom of your screen, so you can type any questions that occur to you through the webinar, and at the end we will get through to that. Other points is a recording of this webinar will be sent to all attendees, so you can watch it back at your leisure if you miss anything, although of course you can always just ring us up and ask us if you have any questions. If you have any technical queries, any problems logging on, you can also go to the question and answer section there. Last point, at the end of this webinar, we'll remind you that we always offer for our webinars a copy of the book we promote, which is called Enough, which is to do with our style of financial planning and how you might like to use that planning in making sure that you don't run out of money in your lifetime. I think that's everything for the moment. So without further ado, I'll hand over to Scott Gallagher, Chartered Financial Planner here at Rowley Turton, and he's going to talk us through private medical insurance and why that might be of importance to you. Scott.
Thank you, Martin, for that kind introduction. We'll start off with growing health needs as we age. Most of our clients, to be fair, are in the 50s, 60s, 70s and 80s. And what we've noticed is that they have an increasing need for treatment as we age, whilst we're typically living longer and typically are healthy. There are still health needs and treatment that we need. And I think that most of us will not have overlooked the fact that the NHS has struggled, certainly post-pandemic, with waiting times, which I think are getting better, but they've certainly not been in a good place. And effectively rationing of treatment means that more and more people that we see are turning to private options. Some of those common examples are knee and hip replacements, cataracts, some diagnostic stuff and things like that. Next slide, Martin. So just slide it down. No. So just small technical glitch. There we go. So as I say, clients are increasingly self-funding via either private medical insurance, which Sam will talk on about more, personal savings and or investments, pension funds, or even equity release, which is essentially a mortgage against your property for people generally who are older, and we don't necessarily have to pay any interest during your lifetime. Essentially, it rolls up. I'll explain that briefly later. So we've put together 3 case studies of genuine clients and or people we know, and how they've either used private medical insurance and or self-funded, and the benefits to them, and also the we cover the inheritance tax angle of this presentation. So the first were a couple in the 70s, assets comfortably over £1 million that we were talking to regarding inheritance tax planning, to be honest. And they actually both needed knee replacements, and I think they were on an NHS waiting list at the time. And just in general conversation, we were like, well, hang on a second, this is daft. We've got an inheritance tax problem. We're talking about various ways of mitigating that, gifting it, various strategies, etc. And you're here with dodgy knees, not being able to enjoy your retirement. And the current NHS waiting times are somewhere between 3 and 18 months. I think it would have been longer at the time we were speaking to the clients, whereas private waiting times are 2 to 6 weeks. So there's a difference of could be a year, nearly a year and a half in terms of getting your needs done. So what happened? We persuaded them that this was a really good use of their money. So they went privately and paid for it. They saved potentially a year or maybe more of pain or discomfort on an NHS waiting list. It's transformed their lives. They've gained a year of what we would call healthy retirement. So when I do my financial planning with clients, we're typically looking at 3 rough life stages. We've got working, mortgage, kids, putting away in your pension to say from 18 or 21, however we start work, till 50, 55, 60, 65, 67, whenever we retire. Then we've got healthy retirement from the point we retire till what we term later life, which we typically would say would be mid-80s for most people. And then we've got later life, where typically we're not as active and don't spend as much. So in terms of that healthy retirement, if you retire, say, at 65 and we think that later life kicks in at, say, 85, there's a 20-year healthy retirement you have. Well, if you spend a year of your life on an NHS waiting list with dodgy knees, not being able to do things you would like to do, that's effectively 5% of your healthy retirement. Now, if you're 75 with 10 years of healthy retirement left, sounds awful, but it's the way I would look at it. Well, that's 10% of your healthy retirement. So it seems to be a false economy to wait for NHS treatment on a waiting list for too long rather than pay for it privately. Obviously, if you've got private medical insurance, and Sam will explain that in more detail later, that's going to effectively pick up the tab for this in most cases anyway. So that's even another reason for not waiting. So anyway, so they paid for this treatment. They gained healthy retirement. They paid for it because they didn't have private medical insurance. Should emphasise that. Their assets will still comfortably over £1 million, so we've still got an inheritance tax problem. But effectively, their inheritance tax liability is reduced by £12,000. So how do we calculate that? Well, effectively, they spent £30,000 on the 2 knee replacements. They therefore have £30,000 less in their estate. So that when they die, their inheritance tax bill will be £12,000 less, and the children will receive, effectively, had they not paid for it, they would have had £30,000 in the estate, £12,000 inheritance tax. The children received an extra £18,000. So it's not even that the clients really paid for it. It's just the kids have got £18,000 less, but they haven't got £30,000 less because of the inheritance tax treatment. So that's what we're saying about the inheritance tax advantage of either paying for treatment or paying for private medical insurance. Effectively, it's the same principle. That's just one client that we've helped, not necessarily through arranging private medical insurance, although that would have been a good idea, but just convincing them to spend the money and enjoy it. Second scenario was somebody we knew, not a client, we just did a one-off job for them. They were in their 80s. They were very comfortable, house with no mortgage, very secure pension, final salaries, state pension, etc. So quite comfortable, limited savings, and they both need hip replacements, which I think at the time were about £14,000 each. So again, issues with NHS waiting lists, etc. And again, if we're talking about healthy retirement, we're talking about even a shorter healthy retirement. Therefore, even more important that you're not wasting time, as it were, on a waiting list waiting for treatment. So again, second couple, what was the outcome? We had to use equity release to pay for the hip replacement because unfortunately didn't have any private medical insurance, and unfortunately there was no other real resources to fund it. We also topped up the savings at the same time because we wanted some kind of cash buffer to enjoy that healthy retirement. The cost of knee replacements was about £28,000 for the 2. We topped up their savings, as I mentioned. There's no monthly mortgage payment, so their standard of living is the same or better because they've got a bit of savings. But it's important to point out that the interest is rolled up on that £28,000. So there is interest on interest, as it were. So it's not a completely free lunch. The mortgage will reduce the children's inheritance, and it was important that both the clients understood that and the children understood that. But of course, you talk to the children, and of course, they want mum and dad to be fit and healthy and enjoying retirement. That's what they want to be doing, is going without in order for the children to get a slightly bigger inheritance. The 2 children are both grown up, they've got their own houses, both got successful careers, they're both doing very well. They didn't need mum and dad's inheritance, and the £28,000 for these is going to make next no difference to the children when eventually they receive the money. So they were more than happy for the parents to spend it and enjoy the money. And in terms of waiting times, I've got here, I think it was 18 weeks on NHS versus 6 weeks private, so 3 months gained. And people can argue whether that's value for money, but in this particular case, I think it really was. And the third case study, a business owner in the 40s, 50s. This is actually me. This is actually genuinely what happened to me. So I've got a house with mortgage. I've got decent income, and luckily I have private medical through work. I don't have as much savings as perhaps I should have because most of my money is in the pension and the business. And essentially what happened was I noticed hearing loss when on the phone. So I was on the phone to a client. I thought, oh, I can't really hear this client. So I turned the volume up as much as I could and still couldn't hear. And I tried the phone on the other ear and it was fine. And I thought, oh, maybe it's the wire on the phone, the coil. I call my phone wire up, it's terrible. But then I noticed later that when I was on the mobile, I had the same issue. So I thought, well, obviously it's not the phone, it's not the phone wire because mobiles don't have phone wire. So what happened? Well, I was lucky to get into the NHS the same day, which I think was very lucky. And they confirmed it was genuine hair loss. It wasn't earwax or something simple and mundane like that. I was able to make a phone call to the PMI provider, actually via Sam's company, actually, because I couldn't remember who my PMI provider was, as is always the case, but they put me in to who I needed to speak to. I was able to see a specialist within days, so there was effectively no NHS waiting as soon as practical. That specialist recommended a new urgent treatment, which I won't go into because it's a bit gory, but I can tell people privately if they want to know. And that treatment I needed to have within 2 weeks of that problem occurring. Obviously, if I was waiting on an NHS waiting list, it's likely that I wouldn't have got to see the specialist within that 2 weeks, so that opportunity to have that new treatment would have gone and would not be available. PMI improved the treatment very quickly, paid for the urgent specialist treatment. The cost of treatment, I think, was about £2,000 or £3,000. I understand that because I've got private medical insurance, it was effectively cheaper than if I'd gone direct, even if I could have gone direct. And most importantly, the treatment was much faster so within that 2 week time window that was required, and without any need to self-fund. So also I didn't have that issue of, oh, will this treatment work? Is it good value for money, etc.? Because it was effectively prepaid because I had a private medical insurance. So I had no financial consideration of what to do. And for the business, obviously that was a lot better because I wasn't taking time off worrying about my problem. I wasn't off for stress. And again, so if you're a business owner and you've got not only yourself and your partner in the business, but say you've got key people, how much might you save if they could get treated quicker if anything was to happen to them, and they would obviously hopefully be back to work sooner. So I think it's a huge advantage for businesses to own it. I'm a complete convert to private medical insurance because previously I would have been, the NHS will fix you, it'll all be fine. Do I really need it? But having gone through this process, I think it's been, it's been worth its weight in gold for me. I think it's been brilliant. I'll just run past very quickly again why I think the inheritance tax angle is important. Most of our clients are self-made and have got significant wealth. Most of those clients we're talking about inheritance tax problems, or at least leaving decent inheritances to the family, and normally children. So as I mentioned earlier, if we're spending money from the estate and that estate is exposed to inheritance tax as an indirect inheritance tax saving. So if we spent £10,000 from your estate, and whether that was in private medical insurance premiums over a number of years, or if it was for some specific treatment, the real cost to you, or more importantly, your children, is only really £6,000 because of this 40% IHT saving. So if we use private medical insurance, I pay the premiums, or we're using our own savings or equity release to fund the healthcare, all of those measures effectively reduce your taxable estate. So firstly, say you're not really paying for private medical insurance or the treatment because effectively your children do because they get a slightly smaller inheritance. And so it's not really, well, it's not primarily a medical decision, but it's partly a financial one as well. Worth adding that for some clients with estates between 2 million and 2.7 million for a married couple with children, the IHT saving could be 60%. So it's even more compelling to have the private medical insurance and or pay for treatment privately. There's some reasons Sam might touch on for why having private medical insurance is better than self-funding in terms of getting treatment quicker, etc., as I understand it, but I'm sure he'll touch on that. So this is just to explain this difference about either paying for treatment or private medical insurance. So essentially, you'll get a copy of the slides, but if you can't see it, there's essentially two lines. This is a client with more money than they actually need, who is just going to, their wealth is just going to accumulate, and this is just savings and investment wealth, ignores the pension fund and ignores the house, and this is actually a genuine client. And they're younger actually, and this they're 60 anyway, but they're accumulating, so they're still working, planning to retire at 65 and later life 85. And because of the cost of private medical insurance and or treatment, yes, it will have less money at the end when you die. There is a slight difference, which accumulates. It is a cost, but fundamentally, that is not a cost to them in the sense that they just mean they leave slightly less to the children, and the inheritance of children is still going to be very sizable. The children will not notice that difference. And as I've mentioned, slightly lower assets means less inheritance tax for those that have an inheritance tax problem. That's what I'm talking about when I mention this inheritance tax saving. Therefore, hoarding money and foregoing medical treatment or private medical insurance to protect you from those costs if and when they occur, when you've got an inheritance tax problem, doesn't seem to be the most sensible strategy to me. As I mentioned, younger business owners like myself, premiums generally can be paid for the business. It is a benefit in kind on you, and Rebecca will touch on that later. But effectively, you don't see the pain yourself because it comes out of business. So you pay the tax and national insurance on it, but you don't pay the full cost of it directly. So it might be considered a tax efficient benefit in that way, getting money out of the company. It's also worth remembering that when a business is sold, and most people who own a business will sell it eventually, or they exit it essentially at some point, then the sale proceeds, will eventually be subject to inheritance tax for most people, I would suspect, given the value of their pensions, houses, and business sale monies and other bits and pieces. So by paying for private medical insurance now, even through the business, there is potentially a long-term tax efficient saving by spending that money, because effectively you've taken someone out of the business will be worth slightly less because it doesn't have that money. You will receive slightly less on sale from that, but if that money is then eventually going to be subject to inheritance tax, there's effectively an inheritance tax saving. So for me, it's a really good way of using money. Just touching on to staff for a moment, as I say, if you've got key members of staff and you're worried about them not being able to work because they're on a waiting list, or if you're worried about them having to take time if their spouse or children need treatment, which also can happen because private medical insurance can cover both staff but also staff's family, or spouse and family. There's another good reason you might want to consider putting in place that your key team is kind of off work for as little as possible should serious ill health happen. So the takeaways are that most clients don't really pay for private treatments themselves because the cost is ultimately borne by the beneficiaries in terms of a slightly reduced inheritance. Your children, and lots of our clients are by definition children, would rather see their parents enjoy their retirement than suffer on a waiting list and miss out on those precious years of healthy retirement that I mentioned. We've only got one life, and my general view as a financial planner is to make sure that we enjoy it as much as we can, hopefully in good health and in comfort. I say for most of our clients, or many of our clients, the IHT saving saves around 40% of the cost of treatment or private medical insurance. Private medical insurance, I'm increasingly convinced it isn't a luxury. If you'd asked me before I had my own issues, I might have felt it was a luxury and felt that the NHS would ride to your rescue. But having been through this myself, I've also got other clients where they've assured me that they've had medical issues, and the diagnosis that they got through private medical insurance was much quicker and much better. The treatment they had for really horrible diseases that them and their family had was much more specialist, and it was unavailable on NHS, and that it basically extended people's quality of life and all their lives in a number of years in some cases. So I think it's a life choice that can be tax efficient and life enhancing. And it's not selfish to spend money on yourself. I don't think, whilst we're quite keen, or most of our clients are keen on passing on inheritance, I think you should favour yourself and your health in particularly first. So I don't think it's a selfish thing to spend money on yourself. I think it's smart, and as I say, often it's what your family, your children, your spouse, etc. would want you to do anyway. So it seems to be a really good idea and a really good way to spend your money. What is money for if it's not to enjoy and to be as healthy as possible? So if I now pass over to Sam, who will explain what private medical insurance is and explain a bit more about its company and what they do. Over to Sam.
Thank you, Scott, for the introduction. Great to be here with you all this evening. Now, I've got 4 slides that I would like to present to you all this evening. Now, the key thing is I'm focusing this predominantly around individual clients, but the core premise of what I'm going to be presenting to you is replicable in connection with group medical insurance policies as well. So the core elements are transitionable from the individual to the group healthcare policies as we move forward. So Scott, if I could ask you to load up the first slide, please. So here we have what is private medical insurance. It sounds a little bit of a basic thing, but that's generally quite a good place to start. So we're all coming from the same position. So essentially, private medical insurance is a medical insurance policy for the treatment of an acute medical ailment. Now, the key word there is acute. So thereby something that is clinically rectifiable or that can be resolved. So things like hips, knees, cataracts, heart problems, God forbid, cancer. So those are all supported by a private medical insurance plan. However, there are a few things that wouldn't be covered under a healthcare policy because the policy isn't technically designed to facilitate them. And the four key ones are the support of a chronic condition. Again, the purpose of a policy is for acute care, so thereby something that is chronic in nature. Things like diabetes, eczema, asthma would fall outside the scope of what a healthcare policy is intended to do. The second is routine prescriptions. We still do have funded prescriptions in the UK, free in some places as well, so those fall outside the scope of a healthcare plan. Thirdly, accident and emergency care. We have no private A&E facilities in the UK, therefore there isn't the facility to accommodate private A&E treatment. And finally, pre-existing conditions. Now, the purpose of any insurance policy is to protect you against the unknown and the unforeseen, not what you already know about. So therefore, pre-existing conditions are not covered under a new healthcare medical insurance policy. Now, at the moment, we have around about 7.5 million people waiting for treatment under the National Health Service. That has increased from approximately 4.5 million pre-2019, obviously that being the start of COVID. Now, the value of a healthcare policy, as Scott has already touched upon in a couple of different areas, is the ability to expedite treatment and care so that a healthcare policy will bypass the National Health Service waiting list and allow you to obtain treatment in the most expedient way possible without you necessarily having to self-fund the treatment yourself as well. Now, from our perspective, medical insurance is relatively unique in the landscape of insurances in the sense that it is something, again, as Scott has already touched upon a little bit, that you are almost guaranteed to use. Because unfortunately, as we all get older, life happens, and by that, medical conditions arise. As one becomes older, they become potentially more frequent, in most cases, more complex, and then by extension, more costly to treat. So the value of a healthcare plan is it protects you from those eventualities, which ultimately will come around at some point in the future. Now, as Scott has already said, again, to repeat myself a little bit, but the value of a healthcare policy is the direction of care that you are able to achieve. So when you are within the National Health Service, to a greater or lesser extent, they say when, they say where, they say who. With a private health insurance policy, you say when, you say where, and you say who. And perhaps the most important thing is the ability to access care, treatment, and drugs that are not available to an NHS patient. Now, I'm sure you will all be familiar with an organisation called NICE. NICE are the regulatory body that authorise and approve treatments that can be offered through the National Health Service. Now, unfortunately, what a lot of people don't realise is that there are a huge amount of treatments that are available in the UK, but are not available through the National Health Service. And this is particularly important around cancer care specifically, where you see in the tabloids and the press the ruinous costs of certain advanced biological targeted cancer treatments and therapies that can sometimes routinely cost tens of thousands of pounds. A healthcare policy will insulate you from that eventuality and that exposure, because even under the most basic healthcare policy, cancer treatment is fully funded. Now, moving on to why us as independent healthcare solutions. And very simply, we do exactly what we say on the label. We are an independent, whole of market medical insurance broker. Our aim is to ensure that our clients have policies that meet their requirements, both in the terms of benefits and budget, but more importantly, that our clients have the foundational knowledge to be able to make a fully informed decision about what type of policy represents their requirements in the best way possible moving forward. And as part of our process, we will help clients understand the pros and cons of different levels of cover and different mechanisms to help them achieve what they want for their long-term goals and requirement. Now, as a broker, the benefit of us is that we are regulated to give advice and guidance. Now, that differs quite dramatically from working with an insurer directly, because they do not routinely give advice or guidance, and they certainly can't comment on different insurers' policies, whereas we do have that ability, freedom and insight to share. Now, as a company, we were founded 30 years ago, back in 1995, by our managing director, Phil Nielsen, and we were founded originally as predominantly a group medical insurance specialist. Now, as the market has changed and evolved, and as people's requirements have changed, the market has developed in such a way that we are very much more heavily involved in the individual space now as well. And just to give you an example of that, 15 years ago, 95% of our business was predominantly focused around groups, 5% individual, and now 40% of all of our clients are individuals and 60% make up the difference, that being the group clients that we still support as well. Now, as part of our service, we automatically offer all of our clients a full annual market review. Just like you would review your car insurance, home insurance, you would review your pension and financial arrangements. Medical insurance is no different. So we always offer all of our clients, group or individual, a full market review and analysis each year. And we do that with the intention of achieving two things. One, to secure the best terms possible from the incumbent insurer. Much like any other type of insurance, if you don't ask and if you don't negotiate, the insurer will not willingly give you their best price. We do that for you. And secondly, the purpose of the review is to help you consider and explore potential other insurers if that is something that you may wish to look at as an alternative to the incumbent provider as well. And finally, we don't charge any fees for our services. We are remunerated by commission, slightly differently to the Rowley Turton team who charge fees. But to be clear, any costings we provide would be exactly the same if you went to the insurer directly. So there's no additional cost to you for us being involved in the process in any way, shape or form. If we can move to the second slide, please, chaps. So moving on to the cost of healthcare. So as we've alluded to through the time this morning, and as Scott has addressed, there is value around medical insurance when compared to self-funding care, and that we will come on to in a few months as well. But just to give you an idea, so focusing on someone who is uninsured and around about the age of 60, how much is a basic medical insurance policy going to cost them? And that will be a national average of approximately £1,000. Now, there is an element of geographical location that will influence the premium, but national average around about £1,000. And as we can see from the bullet points on the slide, a base healthcare policy will fully fund all inpatient, day patient care, fully fund CT, PET and MRI scans, offer access to all private hospitals and NHS hospitals that undertake private care, and fully fund all cancer treatment, including those drugs that are not available through the National Health Service from the point of diagnosis. And as a final point, with the inclusion of a virtual GP service, that being particularly important in the environment that we now find ourselves in, where GPs are under so much pressure, and the first hurdle people will often fall at trying to access care is they physically can't get in to see the GP until it's 3 weeks next Tuesday. So there is that inclusion built into all healthcare policies as a standard feature as well. Now, when we think about a healthcare policy, because all of the policies are modular, which is very good from a consumer's perspective because it allows you to refine and dial in the policy to what you want. But unfortunately, the problem with more choice is that it often leads to more confusion and thereby extension inaction. So how we advise when it comes to a policy is we really break it down into the simple elements. And there are two. There is the underwriting. So for someone who is uninsured, that would be something in most cases that is referred to as a new moratorium. And then there are the benefits, which broadly break down into comprehensive, intermediate, and basic. Now, the way a moratorium works is actually a lot more favourable than people would often assume. So people have a lot of misconceptions about healthcare, that it is a lot more punitive or restrictive, or there is limited value in a healthcare policy because of previous health conditions. People will often also assume that family health, just like it would do for certain other life insurance contracts, would be punitive to them depending on what their family health history is like. But for a personal medical insurance policy, that is not the case. So how the moratorium works is in three key areas. Any new condition is covered with immediate effect. There is no qualifying, waiting period, or screening required. Secondly, any condition that arose and has been fully resolved 5 years ago or more is also covered with immediate effect. And that's particularly important because people will often say, I had X condition 20 years ago, therefore it will not be covered under a policy in the future. There's no point in me having a healthcare plan. The reverse could not be any truer. As long as the condition has not been present for the last 5 years and has been fully resolved, it would be covered in the future should it reoccur. The big one that people will often lead to the conclusion of is, unfortunately, cancer in that respect. Now, the final thing that is not covered is pre-existing medical conditions, and that is anything within the window of 5 years before you were to start a healthcare policy. Now, the thing that people will often miss, devil being in the detail, is the benefit of the moratorium is not only does it cover historical conditions and new conditions, but once you have had the policy for a period of 2 years or more, if a condition has not reoccurred within that 2-year window, it is automatically included for benefit at a later date. So the benefit being a pre-existing condition can ultimately become covered if you have 2 years symptom, treatment and advice free. Now, moving on to the benefits of the policy, comprehensive, intermediate and basic. Now, we've already covered what a basic policy does. Fully funded inpatient and day patient care, fully funded scans, fully funded cancer care. An intermediate policy will include one additional element, and that is outpatient care. So that would include consultations, diagnostics and rehabilitation. And the reason it's classed as an intermediate plan is because the benefit would most often be capped at generally £1,000 per member per policy year. And then a comprehensive policy would simply enhance that £1,000 limit to unlimited. Now, in and amongst that, there are various other elements that are built into a policy, things like excesses, hospital access, consultant access. But if we're thinking about the core pillars of a healthcare policy, it is the underwriting and the benefits. If we can move on to the next slide, please, chaps. So here we have, what other care options do you have? I've spoken a lot about the benefits of a healthcare policy, and Scott has gave very good testimonial of his own interaction with the healthcare policy, but there you do have other healthcare treatment options available to you. There is the National Health Service, free to everybody at the point of use. Now, as we can see on this slide in the table, we have gave a little bit of additional information about what some of those NHS waiting times can be across the country. So there are 5 very common conditions here: a stent, cancer treatment, knee, hip and a cataracts. So stent, just to be clear, if you're having a heart condition and you're rushed into A&E, a stent may be fitted as an emergency, but if you are having a pre-planned stent fitted, that can take anything up to 36 weeks. Now, cancer care, 33% of all cancer patients are waiting over 2 months for their treatment to start, which is astounding, unfortunately. Now, moving on to hips and knees, anything up to 55 weeks, and a cataracts operation, anything up to 42 weeks. So that's the National Health Service. Moving on to self-funding. As Scott has outlined, that self-funding is an option available to all of you. But the question is, knowing what we know about the National Health Service and the problems in accessing care, and thereby the likelihood of you having to self-fund treatment is much greater than what it has been historically, is self-funding a cost-effective mechanism in some cases? How much of a war chest do you need to have set aside to fund care moving forwards if you can offset the exposure for £1,000 a year there or thereabouts? So the cost of a stent being fitted, £11,000. Cancer treatment, ruinously expensive, anything from 28 to £130,000 if we're talking about the inclusion of some of these very expensive targeted drugs, which unfortunately are becoming a lot more commonplace, which is fantastic for patient outcomes, but unfortunately extremely costly to have to self-fund. And the routine things, hips and knees, £14,500 each, and a basic cataracts operation, £3,500 per eye. Now, the thing with these conditions that we've outlined here, most of you will have known people who have had one or several of these conditions individually. Some people will be fortunate and never have any of them, but the law of averages, and ultimately that's what we're working here with, the law of averages say you will have one or more of these conditions through the course of your retirement, that being from 60 onwards. Now, the final slide, we focused on very heavily people who are uninsured. Now, if you are insured, what options do you have? Do you have any options? And the answer to that very simply is yes, you do. So we will often find people will linger with the same insurer for years and in some case decades because they are fearful to change the policy, because if it's not broke, don't fix it. And two things will often be very common with people who are staying with the same insurer. Firstly, because they are uncomfortable and unfamiliar with how a healthcare policy works from a benefits and mechanical perspective, they will assume that for them to have the same level of cover with another insurer, it will not be possible, because they will have to stay with the same insurer to have the same benefits. If they move elsewhere, they will have a reduction in cover. Absolutely not the case. As long as you are working with a mainstream insurer, the likes of Bupa, AXA, Aviva, Vitality, WPA, and a number of others, they will all offer the same types of policy, the same access to practitioners, and the same access to hospitals. Now, the second point there being transferring between different insurers with the inclusion of cover for pre-existing medical conditions. The assumption that people will often make is, if I move from my insurer, a new insurer will re-underwrite me, so that being a moratorium, or they will exclude certain aspects of my medical history. What people unfortunately are not aware of, much like car insurance, you can go from one insurer to another and take your no claims discount with you. You can move between different insurers and take your medical history with you. Now, each insurer has what's called a medical transfer declaration. Now, subject to how you are able to answer those questions, an insurer can offer you exactly the same terms, conditions, underwriting, and inclusion of pre-existing conditions as your incumbent insurer, but generally for a much more favourable premium. So the problem there being, people languishing with the same insurer through inaction, unfortunately, pay significantly more over a prolonged period of time than people who proactively move around different insurers over every 2, 3, 4, 5 years, whenever circumstances permit, which will see a much more stable and suppressed period of premium over the long term. Now, does your policy still meet your requirements? If you've got a healthcare policy, and if you're in the position where you've had it in place for 2, 3, 10, 15, 20, 30 years, as a lot of people will do, does the policy you have still meet your requirements now from when you first took it out 20 years ago? Most people, it will not. So as part of our review, we take people back to basics and essentially say, this is what a healthcare policy does. This is what you want it to do. With that information in mind, does the policy you have now represent what you need it to do moving forwards? And the final point there being loyalty. People will often assume if I stay with my same insurer, when I make a claim, because I've been with them 40 years, they will give me less of an increase on my premium. Unfortunately, loyalty does not pay. And the reason behind that is because policies are all based on what's referred to as a no claims discount scale, just like car insurance. If you claim, you will see a corresponding impact in your premium. It does not make a difference whether you have been with the insurer 12 months or 10 years. The net consequence will be exactly the same. Now, the final point here to close my part of the presentation, people exiting group medical insurance policies, just like people who are currently insured on personal policies, people who are exiting a company healthcare plan will often assume that they have to stay with their company provider to maintain their benefits and to maintain their cover of pre-existing conditions. Just like it is not true on personal policies, nor is it true for those who are exiting group medical insurance policies. And finally, pre-retirement planning, something that we can help you do in conjunction with Scott and Martin. So if you are covered under a healthcare policy and you want to build in a long-term financial strategy to reflect your medical insurance requirements moving forwards, we can absolutely help you do that. And we would encourage you to reach out to ourselves through the Rowley Turton team 12 months in advance of your retirement, so we can discuss the options, the pros, the cons of different things, and partly to give you a little bit of guidance and insight as to do's and don'ts when in your last 12 months of a medical insurance contract. So my part of the presentation now here is done. I look forward to any questions at the end. Scott, I will hand back to you.
Cheers, thank you very much, Sam. That was a fabulous kind of summary of private medical insurance and what IHCS do. I think hopefully a lot of us have learned a great deal about private medical insurance. I've certainly learned some new things listening to that. If we now pass on to Rebecca Gotch, who is the payroll manager at Rowley's, and this is to do with business owners and the payrolling of benefits, and she'll explain more regarding private medical insurance.
Thank you, Scott. Hi everyone, thank you for having me. As Scott's just said, I'm just going to spend a few moments giving you a quick overview of payrolling benefits, particularly in the context of private medical insurance, which ties in nicely to today's session. So if we just move on to the next slide. So if we just go back a slide, sorry. There we go. So what is payrolling benefits? In simple terms, it's a way of reporting employee benefits like private medical insurance or company car insurance through your payroll in real time, rather than reporting them after the year end on a P11D. This makes things more streamlined and accurate, as any change to benefits during the tax year are reflected immediately. One key point to note is that payrolling benefits actually becomes mandatory from April 2026. So now's a great time to start understanding that process and get ahead of this change. So if we just move to the next slide, I've just done a very quick example using private medical insurance. So if you had an annual cost of private medical insurance of say £288 per year, and the amount was split across the pay periods, for this example, this is monthly pay, it'd be £24 per month that would be added to your employee's taxable pay as a notional amount. So this means that that employee pays the right amount of tax as they go along, and there's no need to submit a P11D at the end of the year. So if we just move to the next slide. If this does sound like something you'd need help navigating, especially the mandatory change coming in next year, our payroll team at Rowley's can assist with this. We have a number of clients who process their own in-house payroll. We only get involved when changes like this come in place to just help them get set up and ready to go. So if we just move to the next slide, and obviously if you are looking to outsource your payroll and remove that burden, then please feel free to get in touch. You'll see on the slide a list of the payroll services that are included within that. So if we move to the last slide, thank you for your time. I'm here to answer any questions at the end, but I'll hand you back to Scott and Martin. Thanks.
Thank you very much for that, Rebecca. Quite enlightening. And as a business owner, we've already had a chat about the payrolling of our PMI as well. So that's an issue that we, I think, are aware of. So in summary, we've observed, and there is clearly a growing health needs as we age. We're aging as advisors, and our clients are certainly aging as well. The NHS clearly has continued issues regardless of who's in government. We've run through self-funding options. We've included PMI in that, but I think some would argue it's separately. We're fundamentally paying for ourselves rather than it being through the NHS. We've discussed about the potential indirect 40% inheritance tax saving or 60% inheritance tax saving for some people with larger estates. Sam's run through various PMI options from comprehensive to, well, I've said essential, but I believe it's called basic cover. Rebecca's told you about the payrolling benefit rules for businesses. And yeah, we'd finally say it's not selfish to spend money on yourself, it's smart enough to what your family would want. Just very quickly, we mentioned we are primarily a financial planning practice, and we have a book written by Paul Armson which explains the financial planning process we follow. If anyone who hasn't got that copy of that book wants to drop an email to martin@rowleyturton.com, just with your name and address, we'll send one out in the post. It is a physical book, it is a paperback, so we can't send a PDF, unfortunately, so we do need name and address. And finally, questions and answers. I think I've only got a couple, which should be super quick. I think one for Sam and one for Rebecca. So for Sam, the question is, what are the average annual premiums for somebody age 70 and age 80? I think you gave the age 60 figure.
Yes. So there are a number of factors that can go into that answer. Essentially, type of policy, excess, geographical location. But when I saw the question pop up, I've just had done a quick quote in the background. So to give you an idea, someone who is 70, an annual premium will be approximately, for a basic level of cover or essentials, would be anything from £1,285.44 to be precise. And that will climb for someone who is 80 to approximately £1,500 a year. But again, when compared to the cost of something like a knee replacement at £15,000, that's a decade's worth of premiums just to offset the cost of one fairly routine medical condition.
Fantastic, Sam. Thanks for going with that. And just a question for Rebecca. With the payrolling of benefits and effectively, I suppose, the disappearance of P11D, does that mean that some people who were having to complete self-assessment tax returns will find that they don't need to do that now that that's gone?
No, I believe that they'll still have to, unfortunately, complete self-assessments. I know that's not what anyone wants to hear. But yeah, I believe it will actually, those that used to have a P11D solely on the payroll and weren't actually paid for a payroll either, them amounts will actually go on your self-assessment, and that would actually be paid through your self-assessment now. However, the legislation for mandatory payrolling benefits is not being released till July this year. So we're still open to some changes because HMRC are leaving us till right at the last minute before they give us any more details.
Fantastic. Cheers. Thank you very much for that, Rebecca. If anybody has any questions after the webinar, if you go home and think, oh, I should have asked that, if you drop an email to either myself, Scott@rowleyturton.com, or Martin@rowleyturton.com, and if we can't answer it, if it's a question for Sam or Rebecca, we will pass it on and get them to answer it. Thanks for your attendance tonight. And just a reminder, you will get an email in a few days with both a copy of the slides and a copy of the recording. There's also copies of previous webinars are available on our website, rowleyturton.com. So if you go to there, look in the top right hand corner for resources and webinars, we've done them on numerous subjects, and you can listen to them and watch them at your leisure. Cheers, thank you very much, and good evening.